transaction. Now, notably, unlike Richard Vague's previous businesses, Wells Fargo is not known for being an institution that you do a partnering transaction. If you'll notice, they were not on the list. It was really Citi, GE, JP Morgan, and HSBC that were really the potential partners for Target. Wells Fargo wasn't on that list. Perhaps he didn't want to see the business go to one of his competitors, but we think ultimately he should have been the one more than anyone pushing for a transaction where the company exited the credit card business. We also think that while he's I think again, a very well-regarded bank chairman, Wells Fargo, particularly during this financial crisis, it's got to be a major time-consuming enterprise for him. Target is a customer, a meaningful customer of Wells Fargo, so we think there's a potential independence issue. But when we compare him to Richard, we have someone who's a pure industry executive. He's built, operated, founded, and sold 2 credit card businesses and businesses that have focused on partnering transactions. Some people have said to me, well, the company's now saying they intend to exit the credit card business. Although, again, if you read this, there was a letter to the editor that was just filed this morning where the company says, looking forward, I firmly believe that Target will not quit the card business. I'm not sure exactly what the company's posture on what they're going to do with the credit card operation, but I think a partnering transaction along the lines of what other retailers have done, we hope that's in the future of the company. We think that having Richard Vague on the board is going to help the company enter a transaction like that. And actually, there's still a lot more to do. It's not a sale of a business. There's a lot of work to be done when you do a partnering transaction. Actually, I would like to ask the question of Richard. Let's assume that you were on Target's board. Let's assume that the company exited the vast majority of the credit risk associated with their card. What functions is this company still responsible for? What business do they have going forward, and how do you think you can be helpful?
Thanks for the question. I happen to be a fan of Target. I shop at Target. I think it's a company that's done lots of great things over the years. In the partnerships that we had that were the most vibrant, the most successful, grew the most, the partner was very, very involved. So in this case, whether Target has further ceded its credit risk and capital responsibilities to a partner, it's going to need to remain very involved in every aspect of the decision. Marketing in a very plenary way, credit, really making sure the customers get taken care of in the proper kid glove fashion. So generally speaking, I would expect them to need to remain active for it to be a great program.
Okay, great. Real estate. Target owns more real estate than really any other retailer. And we think that's a good thing because we think that's an opportunity for the company to create value. They get little, if any, credit for this real estate ownership in their valuation. And we think it's worth exploring whether there are other alternative ownership structures or ways that the company can get the benefit of its real estate while maintaining the critical strategic objectives that they have. If you compare Target to General Growth, a company I know pretty well as other major owners of real estate, retail real estate, if they were a REIT, they would be the biggest REIT in the country in terms of ownership. The company trades at an overall EBITDA multiple of 7.2 times. If you look at, even with large cap REITs that have leverage issues and occupancy issues and they're issuing dilutive capital, they still trade at more than twice the multiple of where Target trades today. If you look at ground lease transactions trade at 2.5 times the multiple of where Target trades today. This suggests to us that, and Target trades at a similar multiple to other similar quality retailers that own a lot less real estate. This to us suggests there's hidden real estate value in the company. When I say us, I mean Pershing Square. I'm not referring to the nominees. I didn't seek out nominees to push through a real estate transaction. I did seek out one nominee who had real estate expertise, and Michael Ashner has a ton of real estate expertise, and he can speak to that. If this group of individuals is elected to the board, including myself, I think it's worth further. I'm going to raise my hand probably at a first or second board meeting and say, look, I'd like to see Goldman Sachs' work papers. I'd like to see the reasons why the company rejected us. And I'm going to ask the board whether it makes sense to do a further exploration of real estate, because we think there may be an opportunity here. I mean, it's telling that other retailers, and Walmart certainly has the financial capacity to own as much real estate as they want. They've chosen otherwise. Target has 15% of its stores that have ground leases in effect. Whether this makes sense or not, I don't know. I don't know from the outside. I just want to be part of the discussion. 8 of the current directors will remain in every circumstance. They turned me down once. They may turn down the notion of looking further. If you don't want the company to even look at real estate transactions, then you don't have to vote for me. But don't deny the board, our other for nominees. Without going into too much detail on TIPREIT, we've tried from the outside to address the company's concerns. I think it's been very difficult because we're not in the boardroom. We don't have all the facts that the company has. But I'd love to have someone on the board who's got very relevant real estate expertise, and they can help the company and the board analyze potential alternatives if something makes sense. If it doesn't, it doesn't. Michael, why don't you introduce yourself?
Well, Michael Ashner, I'm the chairman, CEO of Winthrop Realty Trust, New York Stock Exchange, publicly traded REIT. I've been a dedicated real estate investor since 1981, a property manager and asset manager since 1981. It is the business that I do. My expertise has been across the spectrum of real estate, and that I hope I can be helpful with respect to the issues facing, confronting Target with respect to its ownership of real estate. Separately, one of the areas of particular expertise that I have is with respect to the ownership and management of real estate by companies like Target. That is to say, I have a background in sale-leaseback transactions, net lease transactions, and ground lease transactions. I think it's important, however, to consider that regardless of whether or not the company chooses a different course or maintains a different course, when a company is one of the largest owners of real estate in America, I would think it's incumbent that the board of directors have on the board someone with a background specifically in the ownership, operation, and management of real estate. And I would hope that I can bring some expertise in that regard to the board.
Thank you, Michael. We benchmarked Michael Ashner against Solomon Trujillo, if I'm pronouncing his name correctly. He's been on the board for 15 years. He's an Australian telecommunications executive. I'm sure he knows about telecommunications. I'm sure he knows about technology. But he's had 15 years to convey that knowledge to the board. Can't be that convenient for him to fly in for board meetings. He really can't, in my opinion. It's hard for him to spend a lot of time focused on Target. In this case, we have Michael Ashner, major real estate owner-operator. He's based here. He knows a lot about retail real estate. This is a very important asset for the company. We'd love someone on the board to have that expertise. Myself, you look at Target's board, they own less than 0.3% of the company. The independent directors own less than 0.1% of the company. Pershing Square owns just shy of 25 million shares with a market value of $1.07 billion today. We own several $100 million worth of stock options in a separate fund that you read about in the newspaper. Unfortunately, owning call options on Target stock has not been a profitable thing for a fund that only owns call options on Target stock. Our main fund, principal investment is almost entirely in common stock. It's 26% of our capital. Obviously, that is money we don't want to lose. The company said, look, Bill, you own derivatives, therefore you want to take risks, you're short term. And my response is, the vast majority of our investment is common stock. We've been a shareholder for more than 2 years. We do own derivatives. We have extended the life of those derivatives 2 years at a time. At some point, we're going to either exercise those options or convert those options into common stock. But we're clearly a long-term holder. One's willingness to take on risk is not just a function of what you can make if it works, but how much you can lose if it doesn't. And I am the largest investor in Pershing Square. I have a personal stake in Target approaching 3 million shares. I'm clearly very focused on what's good for Target and how to minimize risk for Target shareholders. And if again, myself compared to the Target board, I own a lot more stock than all of them put together, and I've only been involved in the company for 2 years. My background, I compare myself with George Tamke. He owns 10,000 shares of common stock, including options. He owns 0.01% of Target. He's on 3 other boards. He's chairman of